So picture this. It's the end of 2025, and the crypto world is, well, it's a total paradox. On the surface, things looked absolutely incredible.
Bitcoin was hanging on at a mind-boggling price, $90,000. I mean, for anyone just watching the charts, that number screamed success. It looked like the absolute peak of another legendary bull run. But if he looks just a little bit closer, a completely different story was taking shape.
Because while everyday traders might have been celebrating, the big money, the institutional funds, they were quietly heading for the exits. And I don't mean quietly. They were pulling out billions of dollars. This wasn't some minor correction. This was a huge, coordinated withdrawal. To put a number on it, in just one single week near the end of 2025, institutional crypto products saw outflows of $1.17 billion. So you've got this sky-high price on one side and a mass exodus of the so-called smart money on the other.
It all begs the one question that really sets up this entire explainer. What was really going on? Was the market about to collapse, or was something much, much bigger happening just beneath the surface?
Yeah, the end of 2025 wasn't just another volatile crypto moment. It was a genuine turning point, a time defined by these deep contradictions that had even the most seasoned experts scratching their heads.
And this slide really illustrates that market tug-of-war perfectly. The bull case was solid, right? You had new institutional ETFs for major altcoins like XRP and Solana launching, and Washington was finally providing some real regulatory clarity. But wow, the bear case was just as powerful. You had those massive ETF outflows we just talked about, plus a scary flash crash that wiped out over $637 million in long positions. Those are bets that the price would go up. It was a battle of titans for sure. So to understand it, we got to break down the two giant forces at play. And we'll start with Wall Street.
Yeah, this wasn't just another round of institutional interest. This felt totally different. This looked like the beginning of a systematic, permanent weaving of traditional finance into the very fabric of crypto.
And just look at these names. These guys weren't just dabbling anymore. BlackRock's IBIT ETF was an absolute beast, completely dominant. Citi was partnering up with Coinbase to build the payment rails for institutions. And JP Morgan, they launched their very own tokenized money market fund right on Ethereum. See, they weren't just buying crypto, they were building the fundamental plumbing for its future.
And the key idea driving all this was tokenization. In simple terms, all it means is taking real-world stuff like bonds, funds, you name it, and creating a digital version, a token, on a blockchain. This lets these assets trade and settle with the insane speed and efficiency of crypto 24/7. It's a game changer.
And get this push wasn't coming from the crypto world. Wall Street was just responding to what its biggest clients were demanding. Like John Donahue from JP Morgan said, there was a massive amount of interest. The demand was coming from the top down.
And this brings us to a really crucial point. The new institutional mindset is nothing like the retail speculation we've seen in the past. They don't see Bitcoin as a lottery ticket. They see it as a 2 to 5% piece of a big, diversified portfolio. It's a tool for managing risk. They care about how it contributes to their whole strategy, not just the daily price swings. That's a fundamental shift in thinking.
Okay, so at the exact same time Wall Street was building, Washington was legislating. The second huge force reshaping crypto was this dramatic and unbelievably fast shift in the U.S. regulatory world. It was finally bringing some rules to the so-called Wild West.
And the pace of change was just breathtaking. I mean, look at this timeline. In July, the Genius Act gets signed into law, creating the very first federal rules for stablecoins. Through the fall, Congress is fiercely debating the Clarity Act. And by December, the FDIC is already hammering out the specific rules for how banks can issue stablecoins. In less than a year, crypto went from a regulatory no man's land to a clearly defined part of the financial system.
The proposed Clarity Act was absolutely critical here. It was designed to end the years-long turf war between the SEC and the CFTC. And the idea was pretty simple. Truly decentralized assets, like Bitcoin, would be treated as digital commodities and overseen by the CFTC. The more centralized assets, they'd be considered restricted digital assets, falling under the SEC. Finally, a clear line in the sand. And all of this was part of a bigger shift in Washington. The really powerful Financial Stability Oversight Council officially took crypto off its list of major threats to the financial system. And the SEC itself, under its new chair Paul Atkins, took a way less aggressive approach.
They were even granting these rare no-action letters, which basically gave some crypto projects a green light to move forward. So you've got Wall Street building and Washington regulating. The whole crypto ecosystem was finally starting to grow up, and that meant its impact was starting to be felt far beyond just financial markets and those crazy price charts.
So what does all this talk about tokenization and regulation actually mean for real people in the real world? Especially for those of us outside the financial bubble of New York or DC.
Well, it means stablecoins, you can just think of them as digital dollars, are becoming essential financial tools. They're being used for everything from collateral and decentralized finance, or DeFi, to helping small businesses manage their money. But their most powerful use cases are popping up in places that are facing some serious economic instability.
Just take remittances, for example. Sending money home to your family across borders usually costs on average 7% in fees. With crypto, those fees basically drop to zero. For families in countries like Nigeria and the Philippines who depend on that money, that 7% isn't just a number, that's a lifeline.
And what about when a whole country's currency completely collapses? That's exactly what happened in Iran, where at one point it took 1.42 million rials just to buy a single US dollar. In an environment like that, Bitcoin isn't a speculation, is it? It's a decentralized escape hatch from a failing state-run system.
And this market is just exploding. The 2026 forecast for the stablecoin market is $1 trillion. This isn't just about trading anymore. This is about a brand new foundation for global payments and savings, and it's hitting mass adoption.
Which brings us right back to where we started. This great reset in crypto, pushed forward by institutional adoption and regulatory clarity. It solved a lot of the old problems, but it created a whole new list of unanswered questions for the future.
This whole new landscape raises some huge questions for 2026. Who will Trump put in charge of the Fed, and how will their policy affect this new asset class? Can the core idea of decentralization even survive when Wall Street is taking such a central role? Will that landmark Clarity Act actually make it through the Senate and become law? And maybe the biggest question for traders, has the reliable 4-year market cycle, the one tied to Bitcoin's halving, been broken for good by all this institutional money?
And that leads us to our final, pretty provocative thought. As one analyst pointed out, the arrival of institutions, corporations, and maybe even countries could be smoothing out those violent boom and bust cycles we're so used to. We might be entering a brand new era of longer, more durable supercycles in a market that's not driven by retail hype anymore, but by the slow, steady flow of global capital. The Great Reset might be over, but the new institutional era of crypto, it has only just begun.